You're listening to The Intellectual Investor, episode number 67, Investing Q&A, Small Caps versus Large Caps, Increasing Your Circle of Competence, and Should Value Investors Buy Gold, written by Vitaliy Katzenelson and read by Elliot. To listen to more episodes, visit investor.fm. To learn more about Vitaliy's investing firm, IMA, go to imausa.com. Investing Q&A, Small Caps versus Large Caps, Increasing Your Circle of Competence, and Should Value Investors Buy Gold. Nearly every year, I do a Q&A style lecture for students at universities in Denver. To be honest, it is a somewhat selfish endeavor. I really enjoy doing them, and every single time, I learn something new. But since campuses are closed, I decided to take this year's talk online. The upside is that it was easy to record and turn into a useful podcast for you, dear listener. We've split the recordings into two parts to make it more manageable. This is part 2. Have a listen.
Our next, Vagram, are you there?
Yes, I'm here. Can you hear me?
Please, yeah, we can hear you. So go ahead, please ask your question. Go ahead. Thanks for raising your hand, by the way.
Yes. First of all, thank you very much for adding me to the call. And I would like just to say big thank you for all the work that you're doing, all the help to the community. I enjoy reading the newsletter of Vitaliy, and I follow him on Twitter. So Vitaliy, thank you very much.
My pleasure.
I missed the opportunity to see you in Zurich because I live in Geneva. I was on a business trip, but thanks to the technologies, I can catch up and actually ask some of my questions to you directly, and that's really awesome. So I had a few questions. The first question was about the current situation. There seemed to be a huge divergence between the market sentiment because we could see a very strong rebound in the equities, but we're heading in a very severe recession that is coming soon. We don't know how severe it can be, but there seems to be quite a lot of optimism. I would like just to ask what you think. Do you think that there is actually divergence in the sentiments between the market and what's coming ahead? And also another question about the current situation, are you looking into any specific data related to the virus, like any statistics, any a number of deaths or number of tests that's done? Are you following this, or you think that maybe it doesn't make any sense?
That's a good question. Thank you for these are good questions. So the market is, is basically, I haven't looked at it, I haven't looked the last couple of days, but it's probably very close to a level where it was in 2019, sometime like in mid-2019. So basically, it's almost as if, the coronavirus kind of did not happen to some degree, right? Because, and if you look at some of the hotel stocks, they are, some of the travel stocks, they're basically, they don't look they don't look that cheap, even if the virus, even if they didn't have this, right? So and I just use that as an example. So I'm not sure how much behavior of the market today is influenced by Federal Reserve just basically underwriting the bond market. To your point, yes, I think when I look at the stock market today, it doesn't look to me like it's pricing in a potential potentially severe recession, severe recession ahead of us. The funny part is this: if you look at our stocks, and everybody loves their stocks, and I know this, but if you look at companies that really kind of more or less detached from the economy, and those companies are still cheap. So there's the economy. So the value is still kind of in the doghouse a little bit. What was your second question? Oh, if I look at so I have some friends, so it's kind of interesting. I have some friends who spend 10 hours a day, even almost putting their own databases of data and trying to track different countries, etc., how they progress different country. To me, I spend very little time doing this. I kind of try to stay in a very high level because I realize there's so little value I can add there. Like they can track all these trends, and then think about the sun comes out and maybe this virus goes away. It may not go away, but we don't know this, right? So you do all this work, and all this work could just, become worthless just because sun came out and the virus went away. Or Gilead or Bill Gates Foundation comes out with its own set of vaccines. So I basically, in the beginning, I tried to play this game, and then I realized I can add so little value there. And so what I'm just, I spend most of my time thinking, okay, what will not change? And that's kind of, and we try to err on this side, like, on these companies that won't change in our analysis. And then I also think about what will change, but from a different perspective. And this is something we haven't talked about today. The virus will accelerate a lot of trends that were already in place. Right? So let me just give you this example. 2 months ago, if employees said, I'd like to work from home, maybe companies would be resistant to that. It's possible that after what happened now, companies going to be a lot more receptive to have their workforce, a larger part of the workforce working from home. So what it may do, it may change even after the coronavirus goes away and we forget about the virus, right? What it may change is that we may discover that we have too much commercial real estate. So I start thinking about, I spend a lot of time thinking about this kind of trends. So anyway, so that's kind of, but I spend very little time. I spend very little time trying to model Singapore or, the coronavirus in Singapore or in Spain or whatever. So.
Thank you very much, Vitaliy. Can I ask one more question?
Absolutely.
I wanted to ask if this virus and the upcoming crisis has changed your investment approach. And are you looking, for example, at insider transactions, for example, particularly at this moment?
I mean, we always have looked at that, right? So our investment approach has not really changed. I think the virus introduced kind of new variables, right? It's kind of new variables that we didn't have to think about before. I never had to think about, well, can this business survive if it's closed for 6 months? Like really, we have exposure to 2 retailer stocks, and in our analysis before the virus, we were basically stress testing it. What happens if we go into severe recession, and we would go look at 2008 data. Right, we would look at 2008 data and say, okay, well, how did this business, what did this business do in 2008? Because that was not a normal recession, that was a very severe recession, right? So that was our analysis, kind of before the virus, right? But I was not, the thought of, thinking, okay, would this retailer survive if their store is closed for 6 months? That was not part of my stress testing, right? So today it's, you have to, you have your own set of new set of analysis, like that introduces kind of new variables that we didn't have to think about before. But our overall approach, has not really changed philosophically, or even, I always like to see when insiders buy in stock, like significant amount of stock, especially. I'd love to see that, So that hasn't changed because,
Thank you very much for taking my question. That's really valuable to have opportunity.
Well, it's my pleasure. Thank you.
Thanks, Vagram. Okay, I think we had another question come in through the transom here, and I'd like Kurt. Kurt, are you able to speak, Kurt?
Yeah, can you hear me?
Perfect. Yeah, go ahead. Kurt.
I'm a geologist. I live in Denver. But I'm interested in your approach and kind of how coronavirus has created kind of exploring the tail risk, and how that might have changed your screening philosophy as you look at value opportunities And also, as you do that, thinking about, I've heard a couple people asking questions about recoveries in the US or recoveries in general. In the US, we've kind of been at a fairly expensive point as far as ratios go. And so thinking about large cap, small cap, US, non-US, tail risk and screenings, curious your thoughts on or how you might have evolved your thinking for the current time.
Yeah, I think it's a great question. So there are actually a couple of questions inside of it. So number one, so one thing we've been spending a lot more time doing now than ever before, spending a lot more time on balance sheets, but not just on balance sheets, spending a lot more time looking at liquidity. Okay, yeah, if a company has debt coming due, over the next 6 months, and they don't have cash on the balance sheet to pay off the debt, then that presents a significant risk. So we spend a lot more time looking at liquidity. That's point number one. Point number two, I think probably, and Brendan, you can probably set me straight. I think half of the buying we did over the last months or two was outside of the United States.
That's right. Yeah, no, there's a fair amount of non-US exposure that increased.
Yes, and it's not it's not because we're not patriotic and we don't love the United States, but it's just because a lot of times we can find high quality companies that are incredibly cheap outside of the United States. And then you talk about large caps, small caps, or mid caps. We're always kind of cap agnostic because all we're trying to do, because we're looking for high quality companies and characteristics are for the most part agnostic to the size of the company. You can have a very large company that has no moat and has a bad balance sheet, and you can have a small company, a relatively small company that has a great balance sheet, great management, and has significant advantage. So the size, you can argue that there is a survivorship bias in larger companies because only great companies float to the top, and there is and so maybe if you look at our portfolio, probably have more larger companies because of that. But but when we do searches, I think we just maybe put a few $100 million, like we look at $350 million companies or larger, just because of liquidity. So just when you buy a company, I don't have to buy 50 shares a day, kind of thing. So, but in general, if you can find high quality companies that's run by very good management, and it's a small company, and actually, in fact, we own one company in Norway that's probably $800 million market cap, and so that would be considered to be a small cap. So, Kurt, did I answer your question?
Yeah, the small cap, large cap comment was also about, if I'm correct, there's historically been coming out of these kinds of like recessions, however long it takes for us to get through this, but that small cap comes back stronger than some of the large cap. And I think from the value side, that's kind of what I was thinking.
Oh, yeah, no, and that's true. And also, it's not just that, but also the kind of low quality companies. And I don't want to equate low quality to small cap. That's not what I'm trying to say. But usually small caps, you're right. The small cap index today, I read somewhere, is down still 30-40%, even though the market is down 10 or 12. So the small cap index is down a lot more. That's why it's going to come back stronger when it's over. And also kind of riskier companies will come back stronger when it's over. The only problem is it's a path. And now I'm not talking about the risky companies. I mean, a lot of small companies. I'm talking about riskier companies. It's a kind of a path-dependent comment, because if this thing is over in a month or two, then like low quality companies will skyrocket, right? Because when you come out of a recession, usually low quality companies come back much faster and appreciate much more. But the issue is this: the reason we don't have a portfolio of crappy stocks, because it's the path-dependent comment, right? It's if the virus, if we're still struggling from the virus 8 months from now, a lot of those low-quality companies that with bad balance sheets may not be around in their current form. and therefore they may not come back because they went bankrupt. So, and about small caps, I usually don't like to think of small, medium, large. I just try to think of them as businesses. So crappy small caps may not come back, and the ones that are very good, they will come back very fast. So,
Well, thank you.
all right, my pleasure.
Thanks so much, Kurt. That was a great question. Just want to highlight again, don't hesitate to raise your hand and, ask a question, because, usually I've found that, especially when I'm doing investment research, if I have like what I think is a silly question, it's actually uncovering something really valuable. So it's especially true when doing, talking to management and things. So, go ahead, raise your hand, ask a question. You can ask it in chat. There's a Q&A format you can ask. So, don't hesitate. We've still got some time. So next we've got Ignacio. Well, Ignacio asked, I'll ask his question. He asked, what is the role of gold in an investor's portfolio?
Well, I struggled with this one a lot because I think the issue is this, that even before the coronavirus, our government basically showed that even when you run huge deficits, you can lower taxes, right? And you just run bigger deficits. So and when you do this, you're basically debasing your currency. Your currency should be worth less than it did before. Except the only problem is when you have one currency, currencies don't exist in isolation. It's a comparative game. So other governments did the same thing. So therefore, that's why US dollar has not really depreciated that much, or actually probably appreciated. So, and the benefit of gold is that gold basically you cannot create more of it, right? So it's in the ground or it's in the ground above the ground, and it's a very tedious process to get it from the ground. So the problem is gold, though, you have no idea what it's worth. Like when Brennan and I debate Microsoft, debate Pfizer, we can have a discussion what it's worth, and we can talk about our assumptions, and we can kind of come to some kind of value, to what it's worth. This gold, it's really a story. It's a story that this is currency and it's existed for a long time, and therefore it's worth something. How much it's worth, nobody knows. To me, it became a little bit even more appealing after our government, just basically our Federal Reserve created $1 trillion worth of money out of thin air, and a government just, is just going to issue $4 billion worth of $4 trillion, not billion, $4 trillion worth of debt to plug the hole that's been created by coronavirus. So, from that perspective, I can see how gold is becoming more and more attractive the more debt we create. The problem is the reason I struggle with that, because every time I'm kind of Brennan comes to my office and says, Vitaliy, maybe should we buy gold? I keep looking at the companies we're analyzing, and I look at them, and the companies I'm analyzing, I know how to value them. I know that they have pricing power. If you have inflation, they can raise prices. So, and I always kind of push. I would always think, okay, should I put 1 or 2% of our portfolios into gold, or should I just buy this company that can raise prices and that I can value and I can analyze? And at the end of the day, so far, every time the question of gold came up, we just bought high quality companies that can raise prices. That's what we've done so far. But even if I bought gold, which it's not a rational thing to do, the problem is I would not buy enough of it. I would just buy a few percentage points, and it wouldn't really make that much difference on a portfolio, on the portfolio level. So these are my thoughts on gold. So Ignacio, since you can't really talk back, maybe you can type and we can, so I don't know if I answered your question or not, but it's a kind of a non-answer to a question, because I guess my thinking on gold is, if you own, I understand it, but here's why we don't own it, because we can find companies that that have the pricing power that we can analyze, and that are that have significant margin of safety.
Okay, I think that's great. I'm not getting anything else right now from Ignacio. So okay, let's go now. I want to go to Brian.
Yeah, hi. I have a question. I dialed in late, so I don't know if this has been asked. First, thank you for having this one. It's super helpful. Thank you for your time, Vitaliy.
My pleasure. My pleasure.
My question is, there's a lot of discussion or increasing risk of U.S.-China decoupling.
Yeah.
So I was wondering how you think about it in terms of investing in U.S., also like in terms of investing in China, like if this is a increasing risk along the horizon, like how do we mitigate it? Thank you.
No, I think it's thank you, Brian. Thank you for your question. I think it's a real risk, and in some companies that we own, and I'm not going to mention names, we actually reduced our position size because we realized that decoupling China is a new risk to that business. I think we're probably going to get more clarity as time progresses, which industries will be impacted the most. I would probably see pharmaceutical companies in the past, they relied for API, which is active pharmaceutical ingredients, to come from China. Most likely they're going to bring this, the U.S. government, I'm sure if they haven't done it yet, the U.S. government will probably mandate it that APIs are manufactured in the United States, for instance. What this crisis has exposed, and I wrote about this before, that today, until recently, our whole economy was optimized for efficiency. All we are trying to do is try to minimize the cost of production. Okay, so just-in-time inventory was emphasized because this way you have a less inventory on the balance sheet, therefore your return to capital is higher. I think what coronavirus exposed, it's also can turn into weakness when you have disruptions. So I think we were not optimized for resiliency. And I think a lot of companies, just like you as consumers, just think about it as a consumer for a second. In the past, you had one cereal in the cupboard because you knew you can always go to Walmart and supers and get another box of cereal. Today, we have 3 boxes of cereal, in our closet, in the cupboard, because we are now trying to optimize our household for interruptions in supply chain. So I think it's going to happen on a corporate level as well. I think companies probably going to start carrying more inventory. I think we may have actually a renaissance of manufacturing in the United States. And so it may actually end up being positive for the US to some degree, but it's also, because we're going to have some of the jobs come back, but at the same time, it's going to be inflationary. It's going to be inflationary, but at the same time, it's probably going to result in more automation as well. So it's too early to tell exactly how it's going to play out. Now, one of the previous callers asked me about, this would be one of the things I'm thinking about today. I'm not spending as much time on trying to figure out how's the coronavirus progressing in Spain, but I'm trying to right now thinking about, okay, what are the second and third order effects after this is over? What industries will be impacted? And I think, the question you bring up, I think our relationship with China is probably going to get worse, not better because of this. And this will also have a negative consequence on us because if China was buying Caterpillar tractors before, most likely they will be focusing on buying their own produced, Caterpillar, whatever, Chinese made version of heavy duty tractors, etc. So if GM sold a lot of cars to China in the past, you may see less of that happening. So it's a double-edged sword. So today it's incredibly difficult to kind of to model this whole thing out. So that's my, again, I seem like most of my answers are kind of non-answers because I'm not giving a very clear answer that says this or this, but I'm just, those are very difficult, that's a very difficult question, but I think that's something you should be thinking about as an investor today.
That's great. Thank you. It's great to hear your thought process. I hope to see you in person soon again.
Absolutely.
Brian, thanks so much. Okay, our next question comes from Anshu.
Yeah, hey guys, how are you doing?
Good.
Hey, so as a background, so me and my wife have been having this discussion that, given the huge recession risk that we see coming forth, and not as a scare tactic, but more as a insurance policy, if I may say. We want to, so I'm in my mid 50s and I'm fully invested. And I have been kind of broaching is like move at least 20% or 30% or even a larger half of my portfolio into cash. Any thoughts on this? I mean, I know everybody's situation is different, but just would like to hear your thoughts.
It's a very difficult question, right? Because I don't know what stocks you own. I don't know, like, if you own a bunch of indices. If you own a bunch of indices, I would say, sure, why not? Like, we are more invested today than we were 2 months ago because this market provides us an opportunity to buy high quality companies that are significantly undervalued, whose future is not going to be changed by the virus, right? So our cash balances have declined over the last 2 months, not increased, right? So it's very difficult for me to say what you should be doing from this perspective. If you think what you own today is going to be worth more than 3 to 5 years out, and you're comfortable with that, then I would do nothing. So, but it's so that's, but that's kind of my answer to that. And I just one more thing. I would really like the questions come from students if it's possible, because this was more like how to, this is a question. I really like to answer how to fish questions if it's possible. So so this question is more about the fish, not about how to fish. So
thank you very much.
Thank you, Anshu. Thank you.
Okay, thanks, Anshu. Just as a rule, what I'm going to do is I'm going to let people who haven't had the chance to speak ask a question, and then we've got some follow-ups, and if there's time we can get to those. And Vitaliy, I'll just let you make a call on that. But we've got one more with at least one more. And by the way, as of now, I would encourage people to keep sending questions, and we keep getting these great questions. So so don't hesitate. Raise your hand, ask a question in the Q&A or in the chat. But right now we've got Lorenzo, so I'm going to let Lorenzo.
Hi, Vitaliy. First of all, thank you very much for your time today. I've been watching for 1 hour and a half and still can't wait to hear more. So big thank you.
My pleasure.
I've been reading your books, loving your newsletter. So thank you very much for all the work that you're doing to spread investing around. I've got 2 questions. The first one is, how are you looking at the financial sector right now with the coronavirus and with all of these stimulus that are done by the European Central Bank, by the Fed? And I was interested in investing in some banks in Europe or in US, but I still find it very complicated to figure out what should I look right now in this period, and how should I think also in terms of second level consequences? What should I look into a bank? What can I expect? I mean, I've done some investments already, and banks are not really like my competence circle, but I would like to hear your opinion on the sector and on what you would look for if you would think about investing in financials. So banks or insurances in Europe or in US. And the second question, instead, it's something completely different. I'm not sure even if it's like the right question to ask you, but I'm considering right now with the situation of quantitative easing that is done again by European Central Bank and the Fed, how is that impacting like investing for people that are already retired or they are considering retiring? So they're looking like for some type of products, maybe bonds, maybe some specific type of stocks, ETF, whatever, that are less volatile, but still provide a minimum level of return. And do you think there are like some type of products that could be interesting to look into for people who are at this stage and thinking about my parents who are like in this stage at the moment?
So let me start with the second question first. So and this is not a, so for three weeks ago, we launched a new portfolio, and this is not supposed to be an infomercial, but just it's really kind of, we did it because it made sense. We launched a new portfolio, high quality dividend stock portfolio, because for a long time I tried to build this portfolio. Clients would come to me and say, Vitaliy, we need a predictable income, and it seems like bond market does not have the answer. Can you build a portfolio of stocks that could provide a stable income that would rise over time? And today we can do this, using, I think today it's possible to do this using high quality companies. And for the most part, when you do this, to stay away from financials, REITs, and like MLPs, like master limited partnerships, like that have exposure to oil or transmission petrochemicals. So we were able to do this, and I think today, the portfolio for us yields about 5.5%. So it's possible to do this. You want to be when you do dividend investing, you want to be incredibly careful that dividend does not become a shiny object that completely destroys your analysis. Okay, so the way we've done it, we basically identified universe of stocks that pay, I think, more than 4% or more. And then we just started to analyze each company at a time and value each company at a time. And if it passes our quality test, then we keep going forward. And then the dividend is just kind of an afterthought at the end. And that's how we created this portfolio. So I would encourage you to do this, go through a similar kind of process. Your second question about financials, there's something you said that really stuck out at me. You said, financials are not my core competency, however. So I would argue that this is like when you buy financial stocks and it's not your core competency, you're going to be such a patsy at the table. So you want to make it your competency before you start investing in this, because you don't want to be a tourist in financial stocks, because this is like not a place where you want to be a tourist. Because the second and third order effects there are so complex. So today we own only one financial stock, and it's not based in the US. I would argue that analyzing financial stocks today is incredibly difficult because, and I would argue most of them are incredibly, not all of them, but most of them are very path dependent, because again, if the virus, if we are still talking about a virus 8 months from now, you're going to have much higher unemployment, you're going to have much higher default rates, etc. So I'm basically saying that if you want to start investing in financial stocks, you wanted to make it your core competency before you start investing in them, I guess, or if you still feel very compelled to invest in them, just try to diversify your ignorance, or your lack of core competency, just by tiny positions.
That's what I've been doing at the moment. So it's like my way to get motivated to get into financial, build small position, very, very small, that don't have a big impact on the portfolio, and then start to get going deeper into the sector. But I will definitely not overweight them, because I'm still aware that they're not like the place where I've got an edge.
Yeah, so the difficulty with financial stocks is that a lot of times unknowns are known, right? The financials have so many assumptions, right? The cost of goods sold is an estimate that, if you look at a credit card company, for instance, right? Your revenues, what they are, right? Because that's just interest, fees and interest income, right? But you start looking at your expenses, one of the assumptions there, it's the default, right? So you look at credit card companies, and the defaults, 2 months ago were 2%, 1.5%. While today, suddenly coronavirus has changed it dramatically. And so you have to have a view, first of all, if the defaults spike to, and then now you have to make an assumption, 8, 10, 12%, can they get through this? They capitalized enough. But even after this, you still have to make an assumption, what is the new normal level of defaults? Okay, and this is actually, this is the point actually I wanted to make, which doesn't relate to this directly. Before coronavirus thinking, until 2 months ago, we've been basically conditioned to think by kind of a semi-normal environment, where like a lot of patterns in our head were like, okay, well, we go out to restaurants, we spend, I don't know the numbers, but probably 60 or 70% of spending, I think, probably for food is at the restaurants, and maybe 30% is at home, something like that, maybe 50-50, whatever. So now I want you to think about for a second. If we're still scared about going to restaurants, then our spending at grocery stores may elevate and switch from, let's say, 50-50. Now we are spending 70% of our dollars at grocery stores. So if you're looking at a company like Cisco Foods, the company that distributes foods to restaurants, and you look at the base earnings, what they made in 2019 as your base, you probably are making a huge mistake, because it's very likely if by the time this is over, a whole bunch of restaurants go out of business, number of new restaurants created may become a lower number. Also, this virus might have changed our habits, and now we may end up eating out less in general. So the point I'm trying to make is that you have, like, when we look at the past, at what happened in the past, you have to be so careful not to draw a straight line and assumptions that when we come back to normal, the normal is going to be just like it was in the past. It may change. So I know you did not ask me that question, but I'm still giving you the answer that the question you did not ask me. But anyway, so that's my very long answer to a very good question.
Thank you very much. Much appreciated.
It's my pleasure.
Thank you so much, Lorenzo. So let me just give a quick update here, Vitaliy, with where we are. We've got two people that are new. They have new questions. So they haven't asked a question before. Then we've got a few questions in the queue from people that have asked one question. So I'd like to at least get to the two if we can. And the two, by the way, are one from a DU student that had to leave to go to class at 12.
Okay.
And then we have another one from Zambia. So those are both pretty special. So I'd love to get to those.
Perfect.
If we can.
Perfect.
Okay. So I'm going to read the question from the DU student. So his name is Jack, and his question is: I listened to Vitaliy's 6 Commandments of Value Investing, and I was rekindled with what makes me love finance. I like investing for the sake of owning a piece of a truly exceptional company, but I have learned many other trader-type ideologies since then. It seems that every professor has their own opinion. I also like how simple Vitaliy's models seem to be. So the question: what does a day in Vitaliy's office look like, and what do you spend your time doing? And is this way of value investing sustainable in the future with the increase in artificial intelligence and high-frequency trading? And so Jack says, thank you for your time.
Wow, so such a good question. So it's kind of interesting. So actually, I just wrote this long article that's going to come out this Thursday, which answers actually the question what my day looks like. But there is one caveat. That's what my day used to look like pre-coronavirus, right? Basically, I'm extremely protective of my time. That's probably my most important asset. And so I try, so when I structure my day, I try to spend as much time as possible, focus on research, and try to create this oasis when I can do this. I also find that I do my best thinking early in the morning. So I started to, again, this is a pre-coronavirus Vitaliy. I would get up about 4:30, 5 o'clock in the morning, and I write for about an hour and a half, 2 hours a day. And because I find that I do my best thinking through writing. So the unfortunately, and this is, unfortunately what coronavirus did to me, I realized that a lot of good habits that I formed over the years have been completely destroyed over last month. Because, so what happened, I stopped going to the office, and so my routines changed. Also, for instance, when the market had very, very high volatility, I worked 10, 12 hour, probably 12-hour days. And I wanted to make sure that I sleep, get enough sleep. So I would stop getting up at 5 in the morning. So I started to sleep in, to get up at 7. And because I started doing that, I would write less. So basically the habit I created of writing every day, got interrupted. Another habit that I had is that I would work out with a trainer twice a week. And some people can work out without, they can just go to the gym or do whatever and work out at home, can work out at home. That's not me. I need to have an external pressure. I need to have a trainer who tells me, you do 20 push-ups. And that's the only way I could, kind of force myself to work out. And I've been working out for almost 2 years, without interruptions. So now I haven't worked out in basically 3 or 4 weeks. And then the last one, my diet completely, got destroyed by, be basically at home. So overall, I'm like very appreciative of the time actually I had over last month, because I actually ended up spending a lot more time with my kids, my wife and my kids. But at the same time, there are some consequences. So the reason I'm pointing this out, that there was two Vitalis: Vitaliy pre-coronavirus, which was a lot more methodical, and Vitaliy that's less methodical and less disciplined today. And I'm, about 2 days ago, I started to get up early. I think I get up now at 6 and I write, and I started to walk. Like I walk 30 minutes every morning now. So anyway, that's first part of the equation. But the second part of the equation is value investing going to be impacted by AI? And actually, believe it or not, this is what I'm working on in my book right now. The book I'm writing, which I haven't touched in months, The Intellectual Investor. That's the topic that I'm trying to address. How does a value investor evolve in an environment where you are now not just competing against other value investors and ETFs, etc., but you are competing now against artificial intelligence? And I would argue, without giving away the book away completely, that you need to be a lot more creative now than ever before. So being left brain, being just kind of very methodical and left brain is not enough. Now you need to actually engage your right brain and be creative. So that's kind of my very kind of three-top answer to your question, because I'm still working through this in my book. So when the book comes out, I guess I'll have a full answer to your question.
Okay, great. That was super helpful. So thanks for that question, Jack. The next question comes from Nkandu from Zambia. And so Nkandu asks, what books can one read to learn how to value financial stocks? And then, you sort of spoke about financial companies being within your circle of competence or not, or whatever. How does one gain competency in valuing a financial stock?
That book you just bought, right? We haven't read it yet, but you just, it came highly recommended, right?
Yeah, so that is a book about a company called Svenska Handelsbanken. I'll circle back with a couple book recommendations, but why don't you speak about sort of growing your circle of competence to actually be able to invest in financial stocks and know what you're doing? How does that work?
So I think the financial stocks in general are more difficult to analyze than many other companies. So I don't have a good list of books for you, and I think Brandon hopefully will come up with some. I guess what you want to do, here's what you do. You would identify some well-run financial companies, ignore the valuation, and just start reading their annual letters by their CEOs. I think Jamie Dimon is probably, who runs JP Morgan, probably I would start reading everything he wrote, every letter he wrote for JP Morgan, every annual letter he wrote. I know Warren Buffett reads it. I would probably, and so just try to identify companies like that basically have done a great job surviving through the crisis, and read the letters by their management. I think that's probably a good way to start. I'm not, the financial companies in general are kind of on the periphery of my circle of competence. So I'm not necessarily the best expert in them. So, but Brendan, you have that book you just got in the mail a few days ago.
So the book is called A Blueprint for Better Banking: Svenska Handelsbanken, and a Proven Model for More Stable and Profitable Banking, and it's by Niels Kroner. And so Svenska Handelsbanken is a bank that actually Ed Chancellor, the guy that you just got off the phone with, Vitaliy, wrote about in his book Capital Returns, which is a phenomenal investment book. There's another book, actually I'll do a few more recommendations. So there's another book called The Bank Investor's Handbook. That's by Nathan Tobick and Kenneth Yellen. So I would recommend that one. And then there's another book called Risk and Reward by a guy named Stephen Catlin, and that's about insurance and reinsurance. That's a really phenomenal book. But I would just echo what Vitaliy said. I mean, once you get past a certain sort of basic level of competence, maybe by reading these books, really go into the annual reports of just, banks and insurance companies and asset managers and reading those, in addition to the letters that Vitaliy mentioned, I think is a great way to, just get up to speed and kind of start to see what is good and bad and what works and what what doesn't. So in the US, you want to focus on 10Ks, and then outside of the US geography, just look at annual reports. And I like to read the whole thing. So read the footnotes, read the management discussion and analysis, and really kind of get into the details. And I think if you do that a lot over time, you'll find that your circle of competence grows.
I was going to say I was looking back to see. I think I have capital returns somewhere in my bookshelf, but I can't see it. But what I was going to recommend. So I would read the capital returns as well, because it has a very good chapter on banking. Spend a lot of time talking about Handelsbanken, Svenska Handelsbanken. So I would read that book for sure too. Yes.
That's it right there. I don't know if you guys can see me, but Capital Returns, that's the book. So great. So now we've got a handful of questions.
How about 2 more questions and then we'll go from there? And then we'll wrap it up. Yeah.
Sure thing. We'll wrap it up. And let me do this. So what I'll do like a rapid fire. So first,
okay.
Oh, we've got somebody that joined that hasn't asked a question yet.
Sure.
So I'm going to let him go first.
Okay.
So Sean.
Yeah. Hi. And I'm actually going to be an MBA student this fall, so I guess I count in that pool. I had just a quick question about kind of this growth reverting to value. I think we saw kind of at the end of 2018 with interest rates kind of rising there.
Yep.
At the end, there was a quick flip. And then last year we saw with the whole WeWork debacle and people were kind of, there was that flip again. I'm just wondering now, obviously with the economy in a recession and, we don't know how long it's going to take to get out of this whole thing. With revenues coming down, growth rates coming down, do you think investors and the market in general are going to be more focused on profits and margins, and that can help maybe put some sort of, suspended return to value investing?
I'll be honest, I don't know. I think a lot of people got disillusioned with owning ETFs, because I think ETFs were kind of a panacea for a lot of people, because they felt, when I own ETFs, I'm diversified, and therefore it's a low-cost investing, and therefore a lot of risks been diversified away. And what a lot of people discovered, that if you own a lot of overvalued assets, it doesn't matter if you're diversified or not; they'll still decline. So I think one thing that may change, one thing that may favor value investors, and is the high interest rates, possibly, because the high interest rates favor value stocks. Because if you think like kind of bond analogy, so the value stock is kind of a low duration bond, and growth stocks, because most of its earnings lie far in the future, they're kind of high duration bonds. So if interest rates rise, suddenly company whose most of the earnings lie 20, 30 years in the future, it gets impacted a lot more. So I think the dispersion between growth and value would decline. But I'm not sure if this is just a kind of wishful thinking on my part. So being a value investor. But I think at the end of the day, value investing is just it's a philosophy, right? It's just a rational thinking. And I wrote the 6 Commandments of Value Investing, which is very few thoughts in that chapter are mine. Most of them are just borrowed from Ben Graham or Warren Buffett. But it's just, value investing is really just a philosophy. It's just being a rational thinker and looking for margin of safety, have a long-term time horizon, looking at risk as not volatility, but permanent loss of capital, this kind of things. So those things really don't change that much. It's just a certain type of stocks, benefit from people not caring about risk or interest rates, etc. But at the end of the day, those things probably normalize in the long run. So that's how I look at it.
Great, thanks.
Thank you, Sean.
Okay, so that was a great question. Okay, I think what I'm going to do is I'm going to sort of make a call here. So we'll end the way we started with Mate. Mate has patiently had his hand raised for like an hour for a second question. So
it's very tired. I'm sure the head is very tired.
Yeah, he's probably. Yeah, I mean, I want to give him a break here, so we'll end exactly the way we started with Mate. So Mate, go ahead.
Oh, thanks. Yes, my arm has been falling off. Yeah, it's just going to be a quick question, because I've had a thought when someone mentioned Ben Graham. So, have you ever tried net investing? Do you have an experience in buying fair companies at wonderful prices rather than focusing so much on quality? Generally, what's your view on that?
So I just clarify the question. Fair value. What does it mean?
Like buying companies below net current asset value, like Graham did back in the 70s.
I haven't really done this, and because a lot of times when you have this, a lot of them are bleeding a lot of money. So I'm just going to bring up a company we don't own, but like just as an example, like GameStop, I think at some point maybe still is, it was trading below cash, right? But the company could start losing a lot of money very, very quickly. So yes, maybe, and I'm just going to make up a number. Let's say it has $10 of cash, and this is a $7 stock. So you kind of you buying it below that, it's net assets, except it might start losing $1 or $2 a year of earnings, of cash. So how much time would it take for GameStop to basically run through this cash, and suddenly you're paying above net asset value? So that net asset value, I find, usually works when you're an activist. You can come in and shut down GameStop. You say, we're going to shut down the store, we're going to sell off the inventory, and then the $10 they have, we'll realize it. So we'll buy $7 for 10, and then we'll realize it. But a lot of those nets are basically, it's not like you're a controlling shareholder and you can do this. So this is why we haven't really done this. Let me take it a step further. Brad and I looked at a company in Japan recently that had 90% of its market cap in cash. And it's actually looked like a very decent business that was trading, if you take out cash, was trading 1x earnings. And we still struggled with that because the management, they accumulated all this cash because they refused to pay it out as dividends. And you would just kind of wonder what happens, how are you going to make money if this money, as a shareholder, you will never get this money back. They won't buy back stock, they won't pay dividends. So it's a tricky, even in good cases, like, the company Brad and I looked at was a very, high quality business in Japan. So, and we still kind of scratching our heads and trying to figure out what to do. So in other words, it really comes down to capital allocation. If I have a net and suddenly CEO comes in who says, okay, listen, we have a $10 that sells for $7, let me just give you all the money back. Then I would love to buy that one. But I am yet to see where a CEO says, the CEO comes to the job and says, I'm going to make my job obsolete in 3 months because I'm going to close all the stores and return money to shareholders. That's not that's not, management incentives are not to do that, right? Because their incentives is to also receive a paycheck, so they can keep for their kids' education. So I don't blame them, but anyway, all right. Well, thank you guys. I really want to appreciate everybody who joined this call. This is an experiment for us. I never done this, and I was a little bit nervous just because it's a lot easier to talk to a live audience than talk to a computer screen. But I really there were a lot of great questions. I really enjoyed them, and I hope we're going to do this again, and hopefully this will become something we do maybe once every a few times a year. So maybe this is a positive chance, maybe that's a new positive change with coronavirus that changes our behavior. And now we'll do Zoom call a few times a year, and maybe, I get to give something back to students. Brendan, thank you very, very much for doing a great job hosting this call.
My pleasure. Yeah, it was a lot of fun, and I thought we got a lot of awesome questions and a really global audience. So I'm super happy about that. So we look forward to doing this again soon. So thanks, Vitaliy.
Thank you.
Thanks, everybody. Bye.
Bye.
Stay safe.
Thank you for listening. This and other investment articles by Vitaliy Katsenelson are based on value investing principles that were first brought down from the mountain by Benjamin Graham and later were popularized by Warren Buffett. To learn more about these principles, visit investor.fm and listen to the first episode of this podcast, titled The 6 Commandments of Value Investing. To learn more about how Vitaliy's investment firm uses these principles to create low-risk, long-term oriented portfolios, visit imausa.com. Enjoy life and prosper.